Welcome to the daily update, where I'll go over the action in the market for Thursday, April 24th, and we'll see how things look for Friday, April 25th. Okay, had a good up day. We're showing some signs of improvement. Unfortunately, we're just kind of at the top end of this crazy range that we've been in. It's very volatile, but under the surface now, we are positive in the short term because we're back above the 20 period moving average. We're still negative in the intermediate and long term, and it's going to take a while for that to switch back if that ends up being what happens. Now, the interesting thing is the market seems to like what's not happening, and there's really nothing substantial coming out of the tariffs or any trade deals or anything like that. There's it's just really hasn't been developing, but the market just has developed this more positive approach to things, maybe the lack of bad news. And so now you have folks that are getting in. My goodness, last Monday we were at the 5,100 level and we're seriously up from that point and showing signs of improvement, but still in a range nonetheless. So we want to be careful about that. And there could be any kind of news that breaks at any time that really has an impact on this current exuberant type attitude that's going through the market. And there's probably some FOMO going on, the fear of missing out. Folks think, oh my gosh, we're at a bottom and we're magically going to go up just like we've done every other time. And so they're jumping in and they're panicking to get in. And you also have some short covering, folks that thought we were going to keep going down. They have to sell to get in and then buy to get back out. And that drives prices up. We didn't see much of a blow off top on Thursday. We went up to Wednesday's high and kind of stalled right about at that point, but we didn't turn and come down. Where on Wednesday we saw a nice gap up and then spent the rest of the day pretty much coming back down. Well, we went back up to those levels again and we're able to hold on to them. So that's more positive price action that we're seeing. All right, so right at the open, we had a higher open. There wasn't really much of a gap. But prices then climbed above the daily pivot at 54.01. So that had been a resistance level that the market was dealing with. It's a psychological level, but it also becomes a technical level. So we got above 5400. We got up above R1 at 54.45. And then we just kind of held on. There really wasn't this wave of selling that came into the market. We held on to the gains and then we just drifted higher, closing at the intraday high. So we were up 2.03%, another nice solid day, but below average with volume. That's one of the kind of warning signs that we're watching. We are seeing a market that has now, for the last couple of weeks, been below average, whether we go up or down, because you have a lot of people that are really confused right now and they're not necessarily willing to jump in. We are positive now in the short term as measured by the 20 period moving average, still negative in the intermediate and long term. Interest rates are continuing to fall, so that's helping stocks. And just really a lack of news right now, but the market's kind of going with it anyway for the time being. We did see short covering in FOMO, the fear of missing out. That's helping drive the S&P up. Mega caps and semis, now they've got a long ways to go, but they had a good day on Thursday, and we saw some real moves up with the Magnificent Seven and a lot of the stocks that really drive the indexes. So when they have a good day, the indexes have a good day. We're still under 30 with the VIX, but we're above 20 and we're coming in at 26.47. That's another kind of warning sign that, all right, we're coming down with the VIX and we like that, but we are still a little more apprehensive when we're in the 20 range, which is where we're at right now. We don't really have anything oversold in the short term. We've been able to work that off. We're seeing some momentum now starting to build in the short term. They are extreme, but a lot of times we use this more as what's this telling us as far as momentum, where the Stochc RSI, the Williams percent are the CCI 14, the 20 is not on the list yet, the stochastics, and then the rate of change going back 5 periods. So This is all showing positive momentum at this point. And we still have the PMO. Some our oscillators are improving. In fact, they're now turning positive. They're picking up this upward move too. But the PMO, it's positive since it's coming up, but it's still giving an extreme negative reading. And then we're looking a little bit better here in the intermediate term where we have both the S&P and NYSE McClellan oscillators. They're starting to get extreme positive. And then some of the PMO studies for the S&P, they're looking a little extreme too. But this also suggests good momentum. And no change to the overall Fed scenario for right now. The dollar's going down, which actually could end up helping stocks because of conversion rates and import-export relationships. But interest rates going down. We're at 4.31% with the 10-year yield, where we had been at 4.39%. And we're finally above that 25 level, at least for a couple of days now. We were at 27. We were able to climb up to 31. Sentiment is still negative, but it is improving. And we're still negative with our trend. The red line is still above the green line. It's a weakening trend because we're shifting from things focusing more over to going down. Now we're starting to go up, and the ADX is picking that up and it's starting to weaken a little bit. With the update, our bias is positive and our momentum, I've changed from mixed to negative. I've switched it over to mixed to positive because ever since we hit that low on Monday, things have looked pretty good. Now, Wednesday was a little suspect because we gapped higher and then drifted lower. And I was like, okay, there's really no strength going on here. Well, the market was able to come in on Thursday and actually show some follow through strength. We did get durable goods. This came in a lot higher than expected at 9.2%. They expected it to be up 1.5%. Last time it was up 0.9%. If you take out transportation, it was unchanged, and they expected that to be up. So that was weaker than expected and also down from the rise 0.7% that we saw last time. This keeps staying the same. Initial jobless claims. We're right around that 220, 230 level, and we're not seeing things falling apart here, which means the employment situation is holding up for the time being. And this is one of the areas that we look at. If this really starts to show weakness, that means that we're likely going into a recession. It's holding up for right now. We got 222,000 claims, a little bit more than what they had expected, and up from the previous reading, but still in that general range that we've been in. Continuing claims actually declined 1.841 million, where it had been 1.878 million. Existing home sales came in at 4.02 million, a little bit weaker than the 4.2 million that they had expected, and also down from the 4.27 million that came out in the previous report. And that could be the interest rates going back up because we saw on Wednesday with the MBA mortgage applications index, that's really been falling. That probably has to do with rates going back up and folks don't want to get mortgages. Maybe they're not really looking at buying any homes right now, and so that fell just a little bit. So here are the jobless claims. Even though we came back up, we are still going down with the 4-week moving average. So this is showing strength for right now, and we're range bound here with the continuing claims. We're coming down just a little bit with the 4-week average, but we're coming more to the lower end of this recent range. And then putting them all together, the red line, these are the jobless claims. And then we have the range that we've been in for the continuing claims. And then the latest unemployment rate at 4.2%. Durable goods did show a real move up here above zero on a year over year basis. And then we take out aircraft, and it was actually positive on a year over year basis, where it was a little weaker on a month over month basis. And this is showing the big move up that we saw. This could be some front running ahead of tariffs starting to really kick in. So there's always that to be aware of. And then looking here at earnings, they still remain very optimistic. Okay, and that's ultimately what drives stock prices. And so we look at the red line here and the black line, that's actually what's been happening. And then forecasts going forward, they're still going up. And so that justifies stock prices going up as well. And then why this isn't just a short cover rally or a bear market rally? Well, you can, it is to a degree. There's been short covering going on, and we're not in a bear market, but we are in a downtrend. But this, according to Carson, other times when we've had a greater than reading of 70% of advancers six times over a 2 week period, and we have seen some big up moves. Now, is that volatility or is this trying to carve out a bottom in the market and then be able to launch up out of that? We don't know at this point. But other times when that has happened, it ended up being positive. According to this, a month out, we're up 85.7% of the time. Also for 3 months out. And then 6 and 12 months out, we're up 100% of the time. So this is in this category, when you look at the NYSE, which has held up better than the NASDAQ 100 and the S&P and the Dow, because there's more value in there. So, and then to see a nice upthrust of advancing issues out of that is usually positive for the market. Buybacks, we're starting to hear a little bit more about that. It increased, it's up 19% so far for the year. That's positive. When a company goes in, they kind of cook the books by doing that. It's like they come in and buy their own stock, and then they can put that on their balance sheet. And it also means there are fewer shares out there, so it makes them more precious. And if a company has enough confidence to go in and spend its own money on its own stock, that's usually seen as a positive thing as well. And then I've been following the 10 to the 3 month, which is not inverted right now. This is the 10 to the 2 year, which is what most people follow. And it's starting to go back up. And you can see once we go inverted and then really start to climb up, then quite often that will be when we do head into a recession. But we're watching the employment numbers. I did a supplemental video on the website, which you're welcome to go check out. There's a link below this video that will take you to the program. And so far, things are holding up. Once we get the next employment report, I'll probably redo that video again because it'll have more up-to-date information. But we're watching this steepening, is what they're calling this here. When it's going up, the steepening of the yield curve. And then sometimes once we go back to being regular, this begins the countdown to see if we're going to go into a recession, or we go on watch to see if that's going to happen. And then insider buying and selling, this could actually be kind of positive. We're seeing some insiders coming in. This is a different way of looking at it than what we see quite often. And it just shows that when we really drop down, but we see the insiders buying on that, that's positive too. They're like, hey, I can get some of my own company stock at a lower price because I feel our company's doing really well. And then gold prices, they pace the expansion in U.S. money supply. We used to have a thing called M3, but that mysteriously went away because I think it gave us too much information. So now, and we have M1, but this is M2. It's looking at how much money is actually out there. And we see a correlation between gold prices and M2, as well as the debt to GDP, all plotted here on the same chart. And this, again, there's attempts to be made to try to label or describe what's happening right now back to 1929. Well, okay. I mean, history doesn't repeat itself. It often rhymes, but it's a whole different world than what we were seeing back then. There's technology that's around now that wasn't then. There's medical advancements around. We have ways of communicating and traveling that we really didn't have back then. So to try to make these direct comparisons between the two, and it just says the dollar really started to go down, and then we had the crash, and the 10-year yield is going up. Well, the 10-year yield's now been coming back down, and it's more within the range that it's been in. Yeah, we want to respect what's already happened and use that as some kind of a guide, but to try to make these actual comparisons and say it's going to play out the same way, I don't buy into that. Some people really do. I like to look at those things and I think they're interesting and they can be helpful. But to try, one thing I don't do is forecast. It's folly. People need to feel like they need an answer about something that doesn't have an answer. And that's why you have conspiracy theories and you have all these forecasts and all these other, I have a whole philosophy about that I teach in my course, but we realize that we can only look at what we see right now, to say what I think's going to happen down the road. Okay, fine. Go ahead. Think whatever you want, but is it really going to be all that helpful? That's my personal opinion about that. Then a very big interruption to U.S. exceptionalism. This is talking about how we've really been underperforming as far as those stocks above their 200-day moving average compared to the rest of the world. And it's true. I mean, this is what we've been seeing, that U.S. stocks have been under pressure than stocks around the globe. And then this is the chart. I show this. I'm not showing it right now because if you look way over on the right, it's starting to come down. And I'm using this more like a sentiment gauge. This is the spread between risky and not as risky bonds. And when this really starts going up, that's a problem. Well, it has been going up here, but lately it's been coming down. And well, this gives you a little bit more of a historical context with that. And then they're like, we have this thing called the ZWAG NYSE breadth thrust, and I've been keeping an eye on that, and we don't have a signal on that right now. This kind of goes hand in hand with the really solid up moves that we've been seeing in the NYSE. They're calling it a super ZWAG thrust signal. Well, we're not there with even a regular ZWAG signal, at least yet. Now, there's a 1 day lag on that chart, so maybe in Monday's video we will see one. But this just looks at when we see really solid upthrust, and here are where the signals happen, and a lot of times they happen at a bottom. Okay, all right. And then what are the probabilities like looking out? And they improve as you go further down the road. Okay, then the number of container ships sailing from China to the US falling off a cliff right now. Yeah, we're in a trade war with China. So it's not like they're loading up all their ships and sending us stuff. So we're seeing a real drop off in that. Okay, so Wednesday was really quite disappointing in my opinion because we really gapped up. We set the high right after the open and then came down. So that's not a real positive looking intraday price pattern. What helped it though is that we were able to pick up with that in Thursday's session, get back up to these highs, and then actually go a little bit above them. We stalled out right here at Wednesday's R3 level, and it looked like you can see how the bars are really getting small here. Folks are just kind of like, okay, I'm afraid to buy, I'm afraid to sell, and we just kind of drifted. But we did close pretty much at the high for the session. And we're up a little bit in the initial overnight session here, so we're seeing a little bit better momentum coming through. Not really seeing any big change here when we look at the intraday chart of growth versus value. The red line and the blue line are pretty much equal, but they're going up, so that's showing some improvement. We want the blue line to be above the red line. And we are seeing some improvement here, but we're just coming back to these previous highs that we were looking at before. When we look at the growth to value ratio for the S&P, we want this to continue to go up. Now, we're in a downtrend on the daily chart with our growth to value ratio, but how you change from a downtrend to an uptrend is first you see an improvement intraday. Now, we've been faked out. It looks like we were really coming back and looking better, and then we fell apart. So we just kind of have to be suspect of this for the time being. So here is the end of day where growth had a good day, up 2.73%. Value was up, but up a lot less. It was up more for the mid caps and actually up less for the small caps. So seeing a little bit of an improvement here. We're hanging on to barely being in an uptrend with the small cap growth to value ratio coming back above the 50-day moving average with mid-cap growth to value. We're in a downtrend now with S&P growth to value, but we're improving, coming right back up about to the 50-day moving average. And a bit of an improvement, but still below the majority of the rainbow here with this growth to value measurement. And we just generated a death cross recently here with discretionary, so that's not positive. Staples have been holding up a little bit better. And we look at the ratio between the two, which is just starting to generate a death cross here, even though we saw an improvement on Thursday. Then looking at some other areas of the market, this is pretty much what I was just showing, only it's the weighted version of discretionary to staples, you can see the overall decline. That's when the market's getting more defensive. And really, we haven't broken out of this downtrend yet, but we are improving. We look at the equal weight ratio here. We are improving. And then the ratio from tech to utilities overall improving, but still in a defensive posture here. Biotech to healthcare showing some improvement, but still declining. And then hotels to utilities, discretionary versus staples, things that you have to have, improving, but still hasn't really changed from that overall downtrend. Retail showing some improvement, but still in a downtrend here. And you can see how it's been underperforming with the SPY. And we're starting to barely cross above 50 with the RSI. So that's a little bit of sign of strength there. And then looking at some bellwether areas where the semiconductors still going down, but you can see how we're coming right back to the top end of this range that we've been in. Home builders, this was the first area to really start to go weak late in 2024. And we're kind of coming back to the high end of this range. Transports, they've been weak, coming back to the high end of the range. Retail improving. And then the regional banks. So we're not really seeing any breakout. We're just kind of going back to previous prices and previous gaps. And then we fill these gaps. And then what's going to happen after that? Are we going to be able to keep going up from there? Or is that just fill the gap and turn and go back the other way? That's what we'll be watching. So, looking at our trend though, because we are still in a negative trend with the red line above the green line, well, we've been going up the last couple of days. So, we're seeing the ADX actually weakening below its moving average, but we are still negative. Also falling below the moving average, but negative in the short term, according to the ADX. And we continue to be below average with volume. The oscillator is going down. Then you can see it here represented by these red histograms. When we're below this line, that means we're below average with volume. For our sentiment, we're really coming down. So fear is coming out of the market according to the Ulcer Index, but we're still above the moving average and dropping further below 30 now with the VIX. But it would really help if we could come down into the 20 area. And when the VIX goes down, the volatility of the VIX also goes down. That's been dropping below its moving averages. The momentum for the VIX continues to be down. And we did get it now for 9 weeks. Okay, we've got individual investors still extreme negative. So, but they've been camped down here for a while. They turned negative and just stayed negative. And we did decrease here with this one fear gauge, so that's coming down a bit, and we're coming down with this other fear gauge, so some confirmation there. We're going back up, but not really breaking out yet, not showing any real conviction with the risk on to risk off ratio, but it is improving. And we're also going back up now and improving with the high beta versus low beta ratio, but we want this to continue to go up if we're going to be more positive. We went up a little bit here with the daily chart of the equity put call ratio. We're going down with the 5-day chart, and we're also going down with the 10-day chart. And we're getting very low readings here with volatility risk premium. And this generally supports the idea that risk is coming out of the market, and that would be more positive. We are turning back and looking better with the advanced decline line. We've been above the moving average based on price. We finally broke back above the moving average here based on volume. So that's more positive there. And we're above zero and advancing with our short and intermediate term advanced decline ratio. We actually ticked down a little bit here, kind of surprising with the advancers decliners. Now, this is over 10 days, so it could be picking up something that happened earlier on, but we were constantly going up here above zero. It declined, but it's still positive for right now. And again, we're not really seeing any new highs here. So this isn't showing a lot of internal strength currently. So the reason why the 5-day and the 10-day moving averages are going up is because it's a contraction of the new lows. And where we slipped below the red line here with accumulation distribution, now we're back above the red line. So smart money indicator number one is positive. We're turning up. It's really hard to see, but the red line here is going back up now. So smart money number two indicator is positive, and we're back above the midpoint and going up. So we went from all three being negative after Wednesday to all three being positive after Thursday. And that just shows the choppiness that we've been in. We did see a cross here. The vortex is now positive. The green line has now crossed above the red line. And I haven't shown this in a while. I really haven't been showing a lot of the advanced decline line studies because we're just kind of chopping along sideways. And there's a couple that I show, and that's pretty much telling us what we need to know. But with this red line going up and the S&P going up. Now this is an apples to oranges comparison because you have the S&P with the NYSE advanced decline line, but it can be helpful just to show that the broader market is actually doing a little bit better than the S&P. And this is some of the strength that first of all, we saw the NYSE holding up better, and now that we've had a few up days, the NYSE is doing better. And then here's advanced decline line. You see, for so long we've been just chopping sideways with the cumulative advanced decline line for the S&P based on price. We're just coming back to the high end of this range. We are improving after really seeing a decline here based on volume. And we're coming back above the moving average, even though the moving average is still declining with the advanced decline line studies for the NYSE common stock. We're coming above the moving average with the S&P, a little bit above a declining moving average with the mid caps, improving, but still below a declining moving average with the small caps. And then the cumulative advanced decline line for the NYSE based on price, for the first time in a while, we've actually seen a nice solid up move here, and we're crossing back above the moving average. The moving average had been declining, so that's showing some improvement there. And we're getting really close to a death cross with the NYSE advanced decline line. If we can really continue to go up, that might avoid that death cross from happening. And then we break it out based on common stock coming back up, but again, not really breaking out much of this downtrend that we've been in. Also improving here based on volume. We are crossing back above 50 with the stocks in the S&P above their 20-period moving averages. This is showing more short-term strength. And one of the reasons we're back to being positive in the short term, we are improving, but still negative with the 50-period moving average, still below 50 with the 100 and the 200. So that's more why the intermediate and long term continue to be negative. We need to see more follow through from these longer term studies. Short term, still in a downtrend. We're not in a bear market because we didn't close down over 20% from the all-time high set in February, but we are in a downtrend with the S&P. And you can see we're coming right back up here to the high end of this range that we've been in. If we could continue to go up, fill these gaps and keep going, that could end up being quite positive. And down below, you see where we were below average with volume there. 5-day rate of change, just going back over the last 5 trading days, we went from extreme negative to extreme positive as we've been coming up. We are improving with the 20, 50, and 200 period moving averages on the S&P. We're extreme now, showing good momentum with the Stochc RSI. Now we want to be a little bit careful because when our short-term indicators become extreme positive and we're in a downtrend, it it can mean that we're not going to stay here very long. We're just kind of going up, wearing off this extreme negative condition before we get set to go down. So we want to respect that and be aware of that too. But we are extreme with the Stochc RSI, the Williams percent R, the CCI 14, but not the 20. It's above the midpoint, but it's not getting us up to an extreme level here. We're really quite extreme here with the short-term stochastic. We're improving, but not quite extreme in the intermediate short-term stochastic. Just now starting to barely turn back up at the midpoint with our long-term stochastic. And again, this is a further subdivision of the short-term time frame. We're positive with the force index above zero. We're showing some improvement with the short-term trend. We've spent a couple of days above these lines, so the lines are starting to turn up. And now, this is why we're positive. We came up to the 20-period moving average, and we couldn't stay above that on Wednesday, but we were able to close above that at the high on Thursday. So this is what's turning the short-term trend back to positive. And we're crossing above the midpoint with our standard deviations channel. So now instead of being in the -1 area, we are in the +1 area. Here's a look at inflation by Truflation coming in at 1.42%. And still negative, but improving with the balance of power. And we're dropping down here. Now, this kind of goes inverse to what you would think. As this goes down, that means we're seeing less of a decline. And so now we are 10.73 below the February all-time high. So we're still in correction territory. If we drop below 10%, if this keeps going down, if the S&P goes up, now we're back in just decline territory, not necessarily correction. If we drop over 20%, that's when it's a bear market. And improving here, haven't shown this chart all that much because we've been just going down here, the bow tie. We're crossing back above the 10-period simple moving average, and we got above the midpoint here, which is the 20-period exponential, and actually closing a little bit above the 30-period exponential. So this is showing some improvement. If we continue to go up, these lines will go up and eventually cross back over and look more positive. We're still neutral, though, with a negative slant with the go, no go, since it shows the lighter shade of purple. And crossing above the midpoint with our highest high, lowest low value chart. No longer extreme and improving with the TTM squeeze with the lighter shade of red. Really coming down with standard deviation as we've been chopping around now. I'll keep showing this chart until we drop below the moving average. Improving, but not quite positive with the ease of movement. Flat with the Arun, and it really hasn't picked up the party that's been going on. And we're starting to get extreme now above this line. Doesn't mean we'll stop, but this is when we really take note of this. When the S&P McClellan oscillator gets above this level, sometimes that can point to some short-term to slightly intermediate-term exhaustion. But when we're above zero with the McClellan oscillator, we're positive with the summation index. So we're going up based on price and seeing a little bit more conviction here based on volume. We are extreme now with the NYSE McClellan oscillator. But you can see we're just coming to the high end of the range. Now, this is the S&P, but the indicators on the NYSE, but we're going up with the summation index for the NYSE based on price and volume, but looking a little extreme with the McClellan oscillator. We're positive with the Swinland trading oscillator. We're above the midpoint in advancing based on price and volume, still giving us a really extreme negative reading with the PMO, but we're positive because we've crossed back above the moving average and we're going up. We're also turning back positive based on price and volume. We're getting extreme with the PMOs that are rising. So that could also suggest good momentum, or it could point to some shorter term exhaustion. The buy signals are continuing to go up and they're not extreme. That's positive. And we're starting to go back up with the PMOs that are above zero. And we are positive now with the slope oscillator. This is short term. We're positive with the MACD after giving us a really extreme negative reading, but we're above the moving average and going up. So we're actually switching over to positive here in the short term. Intermediate term, we're crossing over positive, and we're starting to turn more positive with the tricks. We've already turned positive with the KST. So this bounce up out of this, going down to the 200-week moving average, that was major long-term support that we bounced up off of. The momentum oscillators are starting to pick that up and turning more positive as well. Copy curve, after being extreme, is now positive. And we're not extreme, and we're showing some improvement here with the Sean trend meter. We're above 50 with the money flow, barely above 50 with the ultimate oscillator. So both of those are positive. And for the first time in a while, we're crossing back above the moving average with on-balance volume. If we can stay above that, see the red line turn back up, that'll be more positive there. Crossing barely above 50 with our intermediate term RSI, a little bit more above 50 with the short term RSI. We're positive with the Elder's Impulse system for the S&P, and we're positive with the parabolic SAR. Showing a little bit of improvement here, but this is longer term. This is 50 period, so these lines don't move up, but they are stabilizing right now. If we can stay above these lines and continue to go up, that will improve the intermediate term trend. And we're above the 20-period moving averages because they're the fastest, so we came back over those first, but we still have the 50s, the 100s, and the 200s to deal with if we continue to go up. And we saw a really nice reading after Wednesday with the bullish percent index. It shot above 50. Well, it continues to go up. So this is positive for the S&P. It's not quite above 50 yet with the NYSE, but it's really improving. And we're above 50 and advancing with the NASDAQ 100 bullish percent index. Wondering if we're going to get a signal here if we come down and cross this red dashed line. Now, we started to go back up, and that's when we crossed back above the blue line. We're crossed back below the blue line again. The signal will be generated if we come down to the red dashed line. Since we've been going up, that's causing this signal. Does that mean the reversal could be a downtrend? Okay, just something to throw out there. And the Pring bottom fisher is about ready to issue another buy signal. The first one led to nothing here. It gave us a buy signal and we tanked, and then it went away, and now it's starting to come back again. And we are breaking a little bit above the overhead resistance here with the 20 period simple moving average of the open, high, low, close. This had been acting as resistance at some points along the way. It did on Wednesday. Well, we're breaking above that now. If we can stay above this and see the lines turn back up, that of course will be more positive. And I just wanted to show this. It won't become official until Friday's close because this is a weekly chart. But we're still above this S1 level, but we're still below the pivot point here. We're right in between. And this is showing that recent range that we've been in as well. So we're looking more positive here with the Heiken Ashi with open candles. We're still positive in black. That's pointing up with the Kegi chart. We finally turned over positive with the Renko chart, and we're positive with the three-line break. So we're seeing a bit of different ways that we measure trends. All of them are turning positive now. Long term, this is interesting. We have a kind of a good up move here, and we're actually dropping a little bit with the Zohar check. It's been on a full-on buy signal now for quite some time. Most of 2024, it dropped down a little bit and then came right back up. And then as we've been declining in 2025, it was still at 10. Well, now it dropped down. So we'll see if that can go back up and give us a full-on buy signal or if it's going to continue to drop. Very long-term buy or sell signal. It's still a buy signal. It turns into a sell signal if we drop below zero. And we are improving with our longer term moving averages. The 150, it's getting back above the green line, and the 200 is also going up. And turning positive now across the board in the short term with all the stock indexes. Still negative with everything except the S&P in the intermediate and long term. And bonds are still negative across the board based on price. Commodities are positive in the long term, and the dollar is still negative across the board. And this is more positive. Look at the areas that went up: tech, communication, discretionary. Those are the three big growth areas, and they did well with tech leading the way higher. The defensive area, staples, that's the one that went down. Utilities were up. That typically is more defensive, as is real estate and healthcare. We like the financials doing pretty good, and I'll show you that chart later. But this was more of an offensive type day. But we need to see more than just one day. We need to get out of this range, start to clear some of the moving averages, and see things shift back more positive. Right now, we're just at the upper end of this range. And a lot of positive signals. We started off the day, we read this from the bottom up, with a BPI cross below 70. Well, it went back above it later. Okay. And let's see, the NASDAQ went above 16.8, 16.9, 17,000, 17.1. We had a summation index cross above its 20-day moving average. That happened right after the close. Apparently, it took some time to calculate that. So some positive things with the S&P back above 5,400 and the Dow back above 40,000. Here's the Dow. It's still in a downtrend, and we still haven't cleared this previous pivot point here. And it's also coming back to the higher end of the recent range. But we're positive with the Elder's Impulse system for the diamonds, and we're still in a downtrend coming back to the high end of the range with the NASDAQ. We're positive, though, with the Elder's Impulse system, higher end of the range, though, with the NASDAQ, or higher end of the trading range in a downtrend here with the NASDAQ 100. The momentum for the NASDAQ 100 is positive, and not much of a range here, just showing a little bit of strength because a lot of the recent weakness in the small caps took place at lower prices, but we're still in a downtrend there. Also showing some improvement here with the small caps with the Russell 2000. And we're positive with the Elder's Impulse system for the small caps. Mid caps still in a downtrend and have a lot, they have more damage that they have to repair to turn more positive. But they are positive with the mid caps when looking at the Elder's Impulse system. Still in a downtrend here with the Wilshire 5000. Just it's improving, but we need to see a lot more. And the total US stock ETF also improving, but just kind of coming back to the high end of this recent range. Financial sector doing okay. It was up over 1%. We'd like this to get back above the 50-day moving average. The longer term trend has still been holding up a bit better there, and we like that, but we need to get above this blue line to show some strength coming back into the trend. And the FANG index right on the verge of giving us a death cross. And notice we closed right at that level. Is this going to provide overhead resistance? These are the big mega cap stocks. And seeing an improvement here after we've been really chopping around with the staples to tech ratio. When this goes down, that's more positive. But the trend for this ratio has been going up as the market has becoming more defensive. Saw an improvement here with the semis to tech ratio, but we need to see a lot more. Early 2024, this ratio was really going up, and that was really charging the market higher. This has been showing some weakness. It is improving now, but we need to see more follow through here. And this is a weekly chart of the SOX index, which are semiconductors. We're still above this 200-week moving average. That's the very long-term trend. And the blue line is still going up. So this is still hanging in there for right now. But we're still seeing a general deterioration when we look at the SPY to Staples ratio. Now, we did improve on Thursday, but we're just kind of coming up to the lower end of some of these moving averages here. We need to see this really see some follow through to break through and show some improvement. Apple was up 1.84%, but still in a downtrend. We're in a downtrend with Microsoft. It was up 3.45%. It could be hitting some overhead resistance at its 50-day moving average. Just starting a downtrend here with Amazon, but it was up 3.29%. Google is in a downtrend, up 2.5%. Meta, still below both of the moving averages. It was up almost 2.5%. Nvidia is in a downtrend. It was up 3.62%. Tesla's in a downtrend. It was up 3.5%. Netflix setting another new all-time high. Probably the best looking chart of all the magnificent ones for right now. And really seeing a drop off here as the S&P has been coming back up and it's been starting to outperform the world stocks. So the short-term correlation is dropping off and we're leveling off with the longer-term correlation. Oil was up. We're still more or less in the lower end of the 60s with that. We're still in a downtrend with the dollar and coming down with the 10-year yield. So we're not really breaking out. We're not seeing that freak out week that we saw week before last with interest rates just going to the moon. And we're bouncing back up here with the 10-year based on price. Seeing some improvements, but we need to see more with the Qs to S&P ratio. We need to stay above this and see the blue line going up. We're a little bit above the moving average with discretionary to the S&P, and we're above the moving average with large cap growth to large cap value, but we need to see more. We need these blue lines, the moving averages, to turn back up. So a bit of an improvement with the large caps, a little more of an improvement with the mid caps and the small caps. And we're coming down with the Staples to S&P ratio. When this is really going up, that's negative. That's the market getting more defensive. When this is coming down, the market is getting more offensive, but we've got quite a trend that we are going to need to see shift here. So what's our outlook for Friday? I didn't change this. We're positive in the short term. We are still negative in the intermediate and long term. We will get consumer sentiment. So we'll see how folks are feeling about things. And then any kind of news that comes out about the tariffs and any trade deals and whether it's positive or negative. And this shows the finishing of the economic calendar here with consumer sentiment, and pretty much all the important ones are done for the week. Seasonality, kind of get the whole scheme of things here. For April 25th, we're neutral to positive with the Dow, but neutral to negative with the S&P, and just flat out negative with the NASDAQ for April 25th. And we're finishing out the week after options expiration, which historically tends to be positive. And seeing a little bit of positive seasonality here if we just single out a post-election year, where we tend to look pretty good going into the last few trading days of April. So we are in a downtrend with our long-term growth to value ratio. Discretionary to staples, we're just seeing a death cross right now with that. The moving average studies, they're improving. The short-term one is actually looking fairly positive, but we need to see the 50, the 100, and 200 show more improvement there. The ease of movement, just slightly negative, but it's improving. The long-term special K, that's a long-term oscillator. It continues to be negative. And actually seeing a bit more things here on the positive side. The three smart money indicators are positive. The McClellan oscillator and summation indexes for the S&P and NYSE. The bullish percent indexes for the S&P, NASDAQ 100, and NYSE are positive. The Swindler Trading Oscillator is positive. The Parabolic SAR is positive. The momentum is now looking a little bit more convincingly positive, as well as the Copic Curve. The money flow, the Ultimate Oscillator, and the Vortex has just switched over and become positive. Financial sector is holding up fairly well. It'd be nice if it could get back above its 50-day moving average. And the momentum for the NASDAQ 100 is positive. And then we're just kind of keeping an eye on this mass index thing. I don't put a lot of importance into this. It's a good signal if it happens and it's confirmed with other charts. But like the Pring bottom fisher, we had a signal that would have been just terrible had you followed that. You would have got in at just the wrong time. So yeah, we can use these charts. We look at them, we make note of them, but we don't base decisions around them. Okay, so our conclusion, we are positive in the short term. I did change this part, and we're negative in the intermediate and long term. So we're positive and improving, but we're at the top end of this recent range that we've been in. We want to be aware of that. We're still negative and we're improving a bit here in the intermediate term, and we're still negative in the long term because we've seen a recent death cross and we're still below the 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a great day on Friday, and I will talk to you in the next video.